Will soybeans stabilize under $13 and above $11 a bushel? We are going to ask this to Mike Zuzolo, President of Global Commodity Analytics, and also we are going to ask if the energy markets will bounce back right here on Connected Farmer, your channel to keep you up to date with the latest trends in agriculture and livestock. So, Mike, how are you after Thanksgiving? And do you think that soybean prices will is stabilize in this range?
I think they will stabilize, Luis, because we haven't received enough rainfall yet to say the crop is back to an above average crop. And I say that especially for Argentina, but even for Brazil, I think center west Brazil is still in need of substantial rainfall. Having said that, we, like you and I talked about previously when we got together a couple weeks ago, it seemed as though the cars left the station without the locomotive, in that the beans tried to go higher without the wheat and without the soy meal market. And we do have the soy meal starting to find support. We see it getting back towards the $400 a ton level at the Board of Trade, at the Mercantile Exchange. And we're also seeing support tested and being held in the wheat market, with the hard red wheat futures looking to support the soybeans more than they have the past 30 or 60 days. And so I think the situation is much better from a standpoint that if the beans go higher again, they will be supported more likely by the meal and by the wheat, and that opens the door above $12. The biggest issue, and I'd love to hear what you're hearing and seeing, because you're the boots on the ground down there. What I'm hearing and seeing is that while there is relief in many parts of Brazil, more is expected, but it hasn't rained yet in those dry areas of center west Brazil and in southern Brazil. And most importantly, Argentina is still bone dry, and it doesn't look like a lot of rain is coming until something like 9 or 10 days out. How do you see it from your perspective?
Well, I heard today from a Brazilian analyst that we have still have a long way to wait to know what's going on, because the real deal will be seen by January in terms of the real crop. And but on the other hand, he said that the egg resource number was sort of exaggerated in terms of loss.
Yeah, and this is where the Chicago people are having a tough time, I think, especially the small speculator who's the weather bull, because you had private forecasts come out that were exactly the opposite as these lower forecasts. You mentioned Ag Resource. StoneX, I believe, was one of the groups that put out an estimate a couple days ago, and they're up there with USDA's forecast, up there around 133, 134 million metric tons for Brazil soybeans. I can't go that high yet. I'm stuck at 130 and a half, with the bias that it will get lower and will not grow, especially given what the weather has been as we go into, as you say, January. And so I think that's why the soybeans have been a phenomenal trading market, but it has not been a trending market at all. And I think the weather bull needs more than ever the wheat market and the soy meal demand and the soybean crush margins on their side. I will throw this out as well. This past Thursday, we had weekly export sales released. We saw that the soybeans were a sale of a marketing year low, and yet the actual exports out the door from the United States was up near the top of the range at almost 2.5 million tons, with China taking over 2 million. However, there was about a 540,000 metric ton reduction of unknown destinations, and I'm wondering whether that wasn't China. We had heard earlier in the week that China was looking at U.S. corn and U.S. wheat, but they've been very quiet the last couple of weeks on purchasing U.S. soybeans. And indeed, on Thursday's export sales, we did see China show up as a buyer of U.S. corn. So it seems to me, when I look at the aggregate and the totality of Brazil, Argentina, export demand, and what producers have most in the bin or have most to sell, it would seem to me that the corn market and the corn bean spread would be more active. In other words, the trade would be wanting to buy corn and sell soybeans, especially if the wheat market reignites on dry weather, both here in the United States and Russia, which is every bit as dry, if not drier, than the United States is right now, based upon the models and the maps I keep track of.
Yes, and still about the weather in Brazil, from my experience, I will say that the drought in the center western parts of Brazil never go until the harvest, and we always achieve to recover over the months. On the other hand, in the state of Rio Grande do Sul, from where I'm from, the drought sometimes is significant, but is not all relevant because Brazil always increases surface.
Yeah, and Rio Grande do Sul, if I remember right, is pretty close to Uruguay. And I had talked to a client this week who grows wheat in Uruguay, and he said he has near a record crop in Uruguay at this point. And so there is a big distinction between the Pampas regions of Argentina, southern Brazil, and center west Brazil, and on north. It seems like there's a high variation between these regions, and so it is going to make it more difficult to get a good estimate on the soybeans, especially using a lot of satellite data. I think the satellite data is going to be a lot more difficult to utilize and be of benefit to the private analysts this year and to the official analysts like USDA and CONAB. So I'm like I was probably 30 or 60 days ago, Luis, at this point, that if we're going to have a real soybean rally, we need the wheat and meal, and then we need it to be in January, February. That's where I really see the drought potential curbing yields in Brazil. That's kind of what I am hearing you say as well. Is that right?
Yes. But looking ahead for a few months, we have talked a lot about the possibility of Brazil importing U.S. corn and soybeans, and yet the Chinese hunger over these months. Brazil will not have more grain to sell until then because we don't have anything left. But I think the issue now will be about the competitiveness. One factor that will be a contribution here will be about the increase in biodiesel in Brazil's diesel.
Yeah, and I think the other thing that you can tack onto that is the weakening U.S. dollar against the Brazilian real. Thursday of this past week, if memory serves me right, we were hitting the lowest level in the dollar against the real in 5 months, and at the same time, the Chinese yuan was hitting its highest level against the U.S. dollar in 2.5 years, and so that, I think, is where the funds are buying this market. I think that's the reflationary trade, the currency trade, and I think the weather bull got pushed out of this market in the past roughly 10 days between the Thanksgiving holiday before and after. So I think the market's relatively clean, and that the people that are buying now are going to be more of the funds if this thing's going to really go. And again, I wouldn't look for that to really be the funds to really participate heavily until we get closer to the Christmas holiday or after the Christmas holiday. Having said that, I think that the copper making new 7-year highs, the iron ore making new 7-year highs, this can't do anything but help the commodity index markets and the rising tide lifting all boats right now. So there is an issue here, I think, that we have to be really careful of. If we get wetter again in Brazil at the end of this year, and we've priced in this fiscal stimulus bill here in the United States, and all of a sudden something bad happens or the fiscal stimulus bill doesn't happen, I think a lot of this reflationary trade will be unwound and reversed, and that could be really tough on some of the commodities. And so I'm still cautioning producers to be more of a hedger in this environment than buy it at this stage. Now, if we saw soybeans at the Board of Trade, recent lows around 11.40, recent high around $12. So we've made that 60-cent break. Beans tend to move in 40 to 60-cent increments. I would like to see them move another 40 cents lower, maybe back down towards 11 or 11.10 in lead month futures. Then I could start thinking about buying back some beans or getting long some beans.
Yes, and we have to mention the energy markets. Some minutes before we went on the air, I just read the news that OPEC is increasing the output. Do you think that is related to the vaccines? And yet, do you think that will help a surge in corn prices?
I do think it's related to the vaccines. I think the OPEC countries see that they are making money. Interesting to note, Luis, at a Federal Reserve webinar that was put on a couple weeks ago by both the KC Fed and the Dallas Fed, they noted that shale productivity here in the United States had improved so much in recent years that money could be made by the frackers and the shale producers at $40 a barrel, New York price. And I think the OPEC countries know that, so that when we get above $40, it's a race to see who can meet demand and get the demand taken away from one another. And so at $40+ I think both suppliers, U.S. and OPEC and Russia, which is part of OPEC plus, are vying for that demand, all those barrels of demand. And so I think that's part of the reason why they went into a higher production level of 500,000 barrels a day. I think the other reason is because China is showing no signs of slowing. OPEC has been selling a lot of oil into China. I think the third reason is the idea that the vaccine will come and the U.S. fiscal stimulus bill will come, and there's going to be this pent-up demand of consumption and travel, and they're going to be ready for it. And I think that's really the heart of it. And this goes back to my prior comment. What if that doesn't happen, though? What if that vaccination program doesn't get off the ground as well as it should? What if the fiscal stimulus bill in the United States doesn't happen until after the next president's inaugurated? I think those are real issues that we really have to be careful of as we go through this next 30 days.
And previously in the program, you talked about the Russian crop. How do you put wheat in all of that context?
Yeah, great question. I think what I have seen that's been most pleasing to me since the last time we've talked, the U.S. soft red wheat at the Gulf and hard red wheat at the Gulf, FOB prices have been able to go from about $30 a ton premium to the Black Sea down to about $8 to $10 premium to the Black Sea and France. We are competitive once again. We did lose business. We didn't get the recent Egyptian purchase, or tender, I should say, and purchase. Russia and Ukraine got that again. And Russia's talking about increasing their export quota. But having said all that, we're a lot better looking in U.S. wheat prices for the export market than we were just 30 days ago. And our price of soft red futures being around $6 a bushel compares to almost $8 a bushel at the EU milling wheat price. And so I think that we're really primed for a better winter market in the wheat. And so if Black Sea wheat does not improve, I think what you're talking about with Brazil not having a lot to sell, I think Russian, Ukrainian producers will be in the same boat. They probably feel like they will have oversold their bushels, and they'll be very tight holders of wheat. And it could open us up in the United States to some good February and March sales.
And talking about the profitability, I read today also that nearly 40% of the U.S. Farm income this year was related to farm subsidies. Do you think that would change in 2021?
I think it almost has to, because we really don't have the capital and the ability to outlay the type of money that we have in this past year because of the direct relationship between the foreign policy of President Trump and his trade policy. They were one and the same. And Fortunately, that was something that I saw early on with producers when we were talking to North Korea. We were really talking to China when we were talking to North Korea. And our foreign policy and our trade policy were essentially identical. And the Chinese picked up on that. And that's why, in part, why we are where we are at. That phase one trade deal is taking effect, along with the fact that China had a bad crop in parts of their country of wheat, rice, corn, and even soy and sorghum. So I think this is where, looking forward, we really have to rely upon a weaker dollar in order to get a better trade situation and higher income per acre in 2021 here in the United States than what we got in 2020.
But as we speak, we are getting worsening relations with China.
It's very possible we could be. It depends on who's the next president, in terms of whether we have a more multilateral approach where we try and put the pieces back together and scrap phase one, or whether President Trump somehow gets a second term and then the Chinese realize they're dealing with it in a very, very strict realpolitik type president where the America First agenda butts up against the China First agenda. That's essentially what it boils down to.
Well, and now we have to talk about the livestock producers. Do you see that the holiday season is helping them?
Yes, it is. And the recovery in the cattle has, I think, been led by the hog market. And that tells you a lot, I think, about the seasonals of the holidays and the winter time. We're dealing with retail cut prices of beef that are just too high right now, given the resurgence of COVID and given the fact that we are seeing a lot more strict lockdowns happen almost on a daily basis. And so I'm still in the same spot I was 2 weeks ago, Luis, that we really have to rely upon the pork sector and the hog price to lift us in the cattle price, because I believe the pork sector and the poultry sector win at the U.S. meat counter and U.S. grocery store. I believe the beef sector wins at the U.S. restaurants. And so if we have restaurants that are going down, we have to, all three meat sectors have to rely more upon delivery only, and then the grocery store. And so this is where I think the pork sector is very responsible for what the cash cattle price and the futures price will be the next 60 days. So I am still a hedger at elevated levels. That 118, 119 April fat cattle price would be a good hedge level in my opinion. You get above 142 in the lead month feeder cattle and January feeder cattle, I think you start looking to place hedges on the books. And when you get up to around $70 in February hogs, you start looking to hedge. If we could get above $70 in February hogs, that would open the door up technically, and maybe we'd wait a little bit longer on getting all of our cattle and feeders locked in and let the hogs maybe try and lift us a little bit more in the cattle complex.
Anything to say in addition, Mr. Mike?
Other than thank you for having me, Luis, and you have a great show, and I really appreciate talking to you.
Thank you, sir.